Hello and welcome to our lecture on auditing the revenue process. First, let's start off with revenue recognition. So we understand that revenue is defined as those inflows and basically other improvements to assets of an entity, in addition to possibly using cash or revenue to satisfy the liabilities. And basically how a company generates revenue is through delivering or providing goods and services. It's basically revenue is generated through the central operations of the company. So for example, if you're Starbucks, then you generate money by actually selling coffee. So there are revenue recognition criteria that we need to take into consideration, and in our audit work papers, we have to have persuasive evidence that an actual arrangement has been made. The delivery of that good or services has also been completed and rendered. The price has to be fixed or determinable, and collectability has to be reasonably assured. Now, keep in mind that we have an ASU, I believe it's 2014-08, that has updated our revenue recognition principles, which has also made auditing actually a little bit more difficult. And we understand that in every audit, we have to test for fraud. That is a requirement. And in revenue recognition, we actually look for certain types of agreements. Any side agreement, which can very well happen in sales. Sales always wants to make the sale, and accounting wants to make sure that we have the actual revenue recognition rules in place, such as the price, such as collectability assured. Channel stuffing is basically where you are taking money from one customer and then just basically handing it to another. Oh, let's go back one. And then we have related party transactions. These are very important to us. This is also heavily tested on the CPA exam, and any type of related party transaction we are looking at because this is no longer done in an arm's length. And we have build and hold sales. So we actually have cash sales and we have credit sales, right? Cash sales are pretty easy. You take the inventory out, you actually purchase the inventory, then it becomes inventory, and then you sell it for cash. Now with credit sales, we do have an accounts receivable created, and this is where collectability could be an issue for us, right? Because you're not getting the money right away. So what we want to know when we're looking at any type of revenue process is that there actually is for cash or credit, right? Cash, hopefully we'll get the money and it's done. But then if you do have cash, that it's in payment for those goods and services. And remember, if you have returns, then you have to actually credit sales revenue as a debit account. So here we have a list of transactions in the accounts that are affected. And the reason as an auditor you want to know is because you basically need to know if it is cash receipts transaction, well, that's obviously affecting accounts receivable, and you may get the discount for early payment. So you just need to know what accounts are affected, because that way you'll know what you're pretty much auditing. So now let's talk about the documents. And so this is source documents that you are going to actually investigate as part of your, and include possibly as part of your work papers, right? So you'll need some type of credit approval stating that the entity is actually giving this customer this type of credit. So usually 10,000, 100,000. The customer initiates the order with a sales order, right? So this is how you know as an auditor that yes, this is coming from the customer. They issue a sales order. If it goes above the credit limit, then you need the credit approval form. And some documents that you might ask for, and this would be part of your PBCs, right? Provided by client. And basically you would look for an open order report, right? Because this basically tells you any type of sales order that still has not been shipped. So if it's not shipped, we know that we cannot recognize this as revenue. But also we should make sure that this is in our inventory. Now, a shipping document is a bill of lading, and that's basically telling us that the shipment has occurred and now that it's in the customer. So this shipping document is one of the forms that we actually look at in our AR records to ensure that the sale was legitimate. So remember, we have the sales order, and then that sales order would produce a picking ticket, right? That hopefully that picking ticket will tell the people in the warehouse, get this inventory out. And then it's pretty much an invoice And that invoice would have attached to it the shipping documents showing that this is basically what you would investigate, what you would look at to make sure that the revenue was absolutely good and legitimate and that you feel comfortable as an auditor saying so. And here's our sales invoice. And then the good part about the sales journal is once you have an invoice, then basically this report tells you everything that's recorded. So you may want to actually take a sales journal for a period of time as your PBC to trace that. So you would take the sales journal and say you have a customer in that sales journal. You would go ahead and make sure and follow that through, walk that invoice from the sales journal through. So walk through the process. Then you might also have customer statements, right? So this is mailed, I would say more emailed or electronically at this point in time, right? And basically this is just an account of what the customer owes you, any outstanding balance. This customer statement lives within the accounts receivable subledger. Now remember then, since we do have a subledger, the accounts receivable is a control account. So you should not post any amounts directly to accounts receivable. Everything should go through the subledger, which would mean by the customer. So in this case, you would have customer A, send him a statement, customer B, what they owe, and every transaction, every sales order that's converted to an invoice gets booked to the customer's account in the subledger. There are no top side entries in a control account such as AR. We also know that inventory and cash are also control accounts as well. So when you are looking at an aging trial balance of accounts receivable, basically it tells you the customer what they owe. So this gives us the balance, and then it pretty much tells us if it's current, usually under 30 days, or if it's greater. And obviously the greater the amount of days outstanding, the less likely that collectability is assured. A remittance advice is basically the part that the company sends you. So this might be the check, and then this remittance advice details the invoices that check is paying for. Now, cash receipts journal, we love this in terms of auditing, because if you keep in mind our accounts receivable T account, right, we have beginning balance, and then accounts receivable are increased with sales, but they are decreased with cash receipts to get our ending balance. And these sales we can tick and tie to our sales journal, and these cash receipts we can tick and tie as accountants and as auditors to our cash receipts journal. And then credits. So basically, why would we issue a credit in AR, right? Basically, if there's usually a return of a good, if you've given, so this would be for sales returns and allowances, maybe some sales discounts that we're giving to the customer. And these are credits, and it should be done directly to the customer's account in the subledger. Now, as part of our T account, we have write-off authorizations, right? So that's another area in our T account here for accounts receivable, right? We would have a write-off where we would debit the allowance for doubtful accounts and credit AR for this write-off. And this is a writing off using the allowance method. So that's another reason we would have a credit in our total accounts receivable, that we want to make sure we keep that all in mind when we are doing our reasonableness tests for accounts receivable. So this gives us basically the functions of revenue. So here's, let's go back to that, our order entry. Right here we have the credit authorization, which could be that we are approving the customer to have more of a balance. The shipping of the goods, this is our bill of lading that we have. And then we actually have the billing, which includes the invoicing. And we have cash receipts, which is our credit to accounts receivable. And here in our accounts receivable, the best way to remember this, I would say, is a T account. And remember, the accounts receivable is a control account, so it should have a sub-ledger. And the GL and the accounts receivable should equal, so AR balance in the sub-ledger should equal our balance in the GL. If it doesn't, that usually means you might have some dates wrong. Something was recorded in the sub-ledger for one period and then not booked to the general ledger afterwards. That should always match, and one way to avoid this from happening is if you make sure that this is an automatic and automated process in your accounting information system. So we're going to talk about each of these functions briefly. We just mentioned that the order entry, right, that's what triggers it. That's your sales order. That's how you know that this was originated by the customer. So this tells you as an auditor, okay, the customer truly wants these goods. Then when it reaches your client, then you're going to make sure that they didn't go above their credit limit. This is another report that you can run usually from the accounting information system. This also works out great when you're using IDEA, because you can actually do a balance and check any balance and compare it to your credit limit. Then once you have that, okay, you've got the sales order, it's definitely they have the credit, you're going to ship the goods. Once you ship the goods, you have the bill of lading and the tracking, then you are able to actually bill it and invoice the customer for those goods. Hopefully everything works fabulously, and then you are recording that billing. And once the invoice is generated, then you're going to have a debit to accounts receivable and a credit to your sales revenue. And hopefully then that accounts receivable will get paid. The customer will pay you. And that cash receipts will then go against as your credit to accounts receivable. And both your accounts receivable subledger equals your general ledger. If everything works out perfectly, then everything ticks and ties and we auditors are happy and smiling. That doesn't always happen, obviously, so there is some risk involved. The industry itself, right, if you are in a very volatile seasonal industry, that might add problems. There could be, now that we do have new revenue recognition rules, there are some complexities in that. Then we also have, there could be difficulty in you getting these account balances and making sure everything ties. And then there might be misstatements, and remember, misstatements should not be greater than the tolerable misstatement, so it should be below the tolerable misstatement. If it is, we're good, but if it isn't, then we have problems, because we know we cannot issue an unqualified opinion unless we have it is below this tolerable misstatement. And there's additional risks, control risks, right? You have to actually understand and document the revenue process. This is usually done in an audit memo, and there are specific instructions on how to do that. You also need to make sure that you are testing controls as they relate to revenue. And then you also have to document the risk associated with revenue. And again, the more complex and the more difficult, the higher the risk, right? So then we have a higher risk. So let's talk a little bit more about understanding and documenting our internal controls. First, we need to understand the environment in total. So this is the entire environment, and we need to kind of set our overall bias around that. Then as we take that, we need to actually then understand how management, remember, management is responsible for the internal controls, and they are responsible for the financial statements. And so basically management, we as auditors have to ask management how risks relate to revenue, and use that in our determination of how we're going to say that there is a likelihood that maybe there could be some errors or misstatements. So we have control activities that we go around that as an auditor we need to go ahead and look at. So this is procedures, so SOPs, right? Statements of operating procedures. We usually talk to the controller, we may talk to the CFO, we may talk to the accounts receivable manager. And as part of our audit process, this is one of the main things we do, is we just look through standard checklist questionnaires to make sure. And we also flow chart the revenue process. Since revenue is a high risk, we make sure that we have several of these procedures or these evidential work papers in our audit to make sure we're doing everything that we should to make sure that revenue is properly stated, or as we like to say, free of material misstatement. So we have all this knowledge that as auditors we need to get, right? We need to understand the process. We need to understand how the transactions flow. We need to see how estimates were prepared, especially for allowance for bad debt. And then we need to look at the accounting records and that evidence. So these are all things that you need to do, and this is documented through your work papers and the memos that you're writing, those questionnaires. So we need to make sure we have all of that. Then the other thing we have to do as auditors is we have to ask and understand how management is actually monitoring these controls, right? What is going on? What is the supervisory personnel doing? Are they evaluating the controls? Is this an IT function? Does this lie in the auditing realm? So we need to make sure that we understand all of these pieces. And once we get that understanding, then we actually have to plan the test and perform the test. Most common tests of controls are where we actually talk to, the client and their individual staffs. We look at documents such as those SOPs, such as those any type of manuals that they have. We observe the transactions, and my favorite is the walkthrough. And this is basically where you take an item such as a source document like an invoice, and you walk that invoice through the entire process. When you usually do a walkthrough, more likely than not, you actually do a flow chart to document the process and possibly a memo as you are doing all of this piece. And then you go ahead and you may even try to do a control activity that the client is telling you they're consistently doing to make sure that it truly ends up the way you want it to. So once you document the whole process, then you have to actually put in your work papers, your evidence, right? You have to support what you did, the level of control risk that you have. And then, depending on that risk, is how you would perform your substantive procedures on those account balances. And now this is not an exact science, so it would be low, medium, or high. Obviously, if you're in this way, that means your sample is going to increase, and that also means that you're going to have to do more testing, because the more risk, the more testing that needs to be done. So we should now be very familiar with our management assertions and occurrence, completeness, authorization, accuracy, cutoff, and classification. So cutoff, what we like to do in this, just to kind of test this assertion, is what I call the last 5 and the first 5. Since we're talking about revenue, then we would look at the last 5 invoices in the period, let's say December 31st, and the first 5 invoices in the next period, such as January, to make sure that they're properly recorded in the current accounting period. Classification, you just want to make sure that everything is where it should be. Completeness, this is usually done with a reasonableness test, where you're actually looking at the T accounts for accounts receivable and adding those sales, deducting any cash receipts, any other adjustments like write-offs, and to see how close you end up with the true accounts receivable figure that's on your balance sheet. So in testing for occurrence, right, you want to make sure that there are no fictitious customers or ghost customers, right, because that would be fraud. And obviously, if we have fraud, we have to follow SAS 99 and other procedures. And then you want to make sure that revenue is recorded when items are shipped, not otherwise. Then we have completeness of revenue transactions. So here what we're actually doing is to make sure that maybe that all the invoices follow this numbering sequence, right? So we want to make sure that all the invoices follow that, and you can use that numbering sequence in IDEA to test for it and pretty much have the full population. Here's where you're doing those matches between the sales order and the shipping documents to the invoice. So this is like a 3-way match similar to maybe AP, but now we're looking at it from the AR side. So your sales order is 1, your shipping documents are 2, and your sales invoice is 3. You do want to reconcile those invoices to those sales reports, such as you could do a daily sales journal, as we mentioned earlier. So that sales report, you might ask the client to pull that sales journal, and that would be part of the PBC provided by client list that you give them at the beginning of the audit. Then you may want to look at that open order file to make sure that any orders that are there that the company is going to fulfill, ensure that they have the inventory to do so. And authorization, basically you want to make sure that if they do go over that credit limit, or if they do have bad credit, that it is getting that second round of approval. And you want to make sure that price lists are okay and that they're accurate, that people aren't able to change prices at whim, especially salespeople. You want to make sure that all of those SOPs, standards of operating procedures, are followed. Then with your cutoff and classification, as I mentioned, you may want to do the first 5 invoices and maybe the last 5 invoices. You may also do that for receipts, cash receipts. You just want to make sure that everything is actually put in the correct period so that they're not actually putting revenue in prior year when it should be in the following year. Then for cash receipts, basically what you want to make sure is that you're getting cash from the customers and that it's being deposited in the bank as it should and being recorded to the correct customer. Again, we don't have those fictitious or ghost customers. And as part of the completeness, you want to make sure that you're actually looking for if discounts are offered for early payment, such as 210 net 30, that would mean you get a 2% discount in 10 days. Otherwise, the net amount is due in the 30 days, which is a typical outstanding period. So you want to do a test for that to make sure that that's happening. And then possibly a lockbox system. I'm a big proponent of lockbox. That's a great internal control. Basically, what happens in a lockbox is the customer sends payment directly to the bank, not to the company. Okay, and then the bank deposits the payments directly into the company's accounts and sends to the company the deposit and the remittance. And so that way it's automatically going to the bank and hopefully deposited in the correct account. And you kind of eliminate that issue if the checks are coming to the client and somebody at the client is taking it. Accuracy, you want to make sure that cash is recorded as per indicated in the remittance advice. A test that you do here is when you do your sample of cash receipts, you test to make sure that each one is correct. And this also could be very easily done with IDEA. I talked about cutoff already. The lockbox system, again, helps in this situation. And then you have sales returns and allowances. This should have a return materials authorization. And basically what that means is that the customer is getting, so return materials authorization. And what that does is basically the customer calls the client and requests to return these items. So that's what starts the process for a return, similar to a sales order starting the process for an invoice. So what we do here is now we're looking at the detection risk, which is the risk that we as auditors will find any mistakes. And if you can see here, and again, we care about material misstatements. Keep that in mind. It's all about materiality. So it's material misstatements. And here you see all of the accounts associated with that. So we have accounts receivable, allowance for bad debt. Don't forget that's a contra asset account. Sales, which is revenue, sales return and allowance, that's a contra sales revenue account, bad debt expense, and cash. So here we see our balance sheet accounts, AR, right? We have our AR allowance for bad debt, and we have cash. And we have our sales returns and allowances, and our bad debt expense on our income statement. So as I mentioned, usually if your balance sheet is clean, your P&L is clean. As you can see, since we do have a double entry accounting system, it works out really nicely for us. So let's talk about now auditing revenue as it relates to and all the related accounts. We do substantiated analytical procedures, and that we're looking for relationships here, maybe trend analysis between the revenue accounts. If revenue is going up, hopefully collectability is going up and not our accounts receivable signaling or suggesting that if revenues are increasing but the accounts receivable balance is increasing, then we can have an issue with collectability. We also do a lot of test of details, right? And here we're actually looking at transactions, and we might look at account balances. And here we're looking at the ending balance, and this is where our reasonableness tests come in. Right, and we're just making sure that our ending balances are correct. And don't forget that we have the disclosure notes, and the notes are part of the financial statements. So another great technique we use in our analytical procedures is ratios. So we have the receivables turnover ratios, the days of outstanding and accounts receivable. Obviously, the greater the days, the less likely of collectability. We look at our AR aging, right? And when we look at the aging, we see those categories like current, right? Let's say greater than 30 days, greater than 60 days, greater than 90 days. Obviously, the longer the amount of days, the less likely that it is collectible. One of the most contentious, I would say, accounts receivable tests is the bad debt. Auditors always want more bad debt, and as a client, you're going to get pushback that there's enough. So that bad debt and allowance for uncollectible accounts, right? And remember, we do have the percentage of sales or the percentage of receivable methods or the AR aging method. Large customers that have account balances as later on in the year could be a concern. So these are all the types of tests that we do to ensure that accounts receivable is properly stated. And so here you see a sample work paper and for accounts receivable, and you see the totals, and here is like all of the customers. And then you see our tick mark legend right here, and you see how every number usually has a tick mark, right? And so we footed everything. Here we footed it and agreed it to the trial balance, which is great. And then this particular tick mark here tells us that we traced that to the subledger and we agreed the total to the proper aging, so that we agree that this is a total and that the aging of the 18,875 and the 11,000 is correct. So this is what a typical work paper looks like. Here is the actual work paper, the initials of the person completing it, and the date, and all of the great work. Remember, the work paper should stand alone. I should be able to look at it, or anybody on the audit team, and know exactly what you did. And completeness, this is what we were talking about earlier with reconciling the trial balance to the GL. So you can check if there's any issues or any omissions. Cutoff, I talked about again, that all the transactions are tested right in the prior period. So here is the last 5, and here we would have like the first 5. And obviously, existence is another management assertions that we test, because we want to make sure that this AR is not overstated or sales revenue are not overstated. And one way in which we do that is through confirmation. And basically, we have valuation is next. So here we have to show, right, that our accounts receivable has to be at net realizable value, where we show the gross. So it would be, and remember, on the face of the balance sheet, we have gross AR, and then we would have less allowance for doubtful accounts to show our net accounts receivable balance. So here, to get us to that net accounts receivable balance or a net realizable value, we need to make sure that our allowance for doubtful account is properly allowing for all of the uncollectible accounts that we have. This also goes into, we should classify mostly short-term and long-term when it comes to notes receivable, not really AR, because we assume that AR is usually short-term, right? Because hopefully you'll get it within 30 days. So you want to make sure that that's proper. A lot of the times what we do with receivables is we would show this just as a financial statement reclass, meaning that you can pass on this entry. So if as auditors, we will actually give the client an entry saying, okay, this portion of notes receivable has to be classified to long-term and leave the remaining balance in short-term. You would do this for your audit report that's being issued, but you may not do this internally, because then you're going to reverse it in the next period. So one of the common procedures that we do for AR is confirmations, right? And so this is where we're actually taking a document, and it's actually great evidence, because it's saying that the client prepares the document, but everything should go back to the auditor. And then, and basically the client signs off on it, but the auditor gets the AR balance and makes sure that it is correct. And so if you don't really do confirmations if the amount is immaterial or if it's ineffective. A lot of the times you'll send out all these confirmations, but you won't get very many back. So depending on the level of risk is which confirmations you use and to what extent. So we have we have positive and negative confirmations, which we'll talk about in a minute. But also, when you're actually looking about the reliability of confirmations, you want to make sure, if you've had experience in that industry with another client, what's the likelihood that you'll get these responses and the likelihood that they are correct. So you just want to keep all of that in mind. So let's talk about positive and negative confirmations. So here in a positive confirmation, this is where you're asking the customer, do they agree with the amount due? So this is like just an agreement. So here it's just the customer says, yes, I agree or disagree. Now, if you have a negative confirmation, here the customer only responds when they agree. I think positive confirmations, I would like, as an auditor, you feel more comfortable with those because you're getting a response either way. Whereas a negative confirmation, it doesn't necessarily mean if you don't get it back that they are in agreement. They may just not even look at it and you'll never get it back. So positive confirmations is, in my experience, what I've seen the most of. And when you are looking at confirmations, timing is important. Obviously, you may actually do these confirmations at the interim date and then again at year end, or if there is an exception or a discrepancy. And basically throughout the whole process, the key with confirmations is if you get those exceptions, those amounts that don't agree. And here, what you have to do as an auditor is you've got to look into it, dig deeper, look for those differences, talk to the client, maybe contact the customer and see what's going on. And if you do have quite a bit of these exceptions, or you have not received any of these responses to those positive confirmations, then what you have to do is known as alternative procedures. So here you may have to do subsequent cash receipts, which would be you are looking at the information after the audit date and seeing if you've gotten any payments from the customer. If you haven't, you may have to also then look at shipping documents to ensure that the customer did get those documents and that it is a legitimate revenue. And obviously, if there's any other information that your client wants to give you to substantiate that receivable balance. There is also other receivables, right? You may have receivables from officers and employees like employee advances. And then you may have related parties. Those are very scary for us because as auditors, we want to make sure related parties assumes that there is no arm's length transaction. So because of that, that heightens our risk. And so we need to make sure as auditors that we are performing enough procedures and tests on related party. And the notes receivable, that can usually be confirmed with the bank. And so that would also be as part of the standard confirmation process. And once you do all this great work and now you've done it, you've done your plan, you've done your substantiative procedures, we go back to always that likely misstatement, so we determine, is the misstatement less than the tolerable misstatement? Then we are good. We can say that AR is presented fairly. If not, then we have to say that it's not presented fairly, and we would have to do an audit adjusting entry or propose that to the client to do. And that's all we have for auditing of accounts receivable.